Hi everybody, welcome back to the channel, and if you're new around here, this is the Cash Flow Investor. We talk all about how to take assets in the financial markets, such as stocks, real estate investment trusts, ETFs, all kinds of different various financial assets out there, and we try to turn them into cash flow. That's one of the main things we talk about on this channel. So if you're interested in those types of topics, be sure to hit that subscribe button, and if you like this video, please hit that thumbs up. It is greatly appreciated. If you guys are new to the wheel strategy, that is the strategy we're going to be talking about in this video. This strategy is all about how to earn cash flow. I've made various videos on SPY, for example. I made a recent video on that one talking about how you can earn over $100 per day, potentially doing it a few times a week against SPY. There's also individual stocks such as Palantir. That's the one we're going to talk about in this video. Palantir Technologies. Here's the chart. This is actually live, $40.51. One thing we're going to talk about in this video in particular is the volatility. So you can do the wheel strategy against this stock if you want. The thing to keep in mind is that and this is what I try to stress in my videos, there's two ways you can make money from any stock, right? One way is from the stock going from point A to point B, or let's say from $50 a share to $75 a share, right? You're earning a direct return based upon the share price. Now, the other way is to actually make money from the cash flow. And so regardless of what happens in terms of the share price, you're still going to be earning some type of premium from the stock price. And so when it comes to the wheel strategy, that's exactly what we're focused on. In fact, if we look at this snip that I took last night, this is on the put side. So with the wheel strategy, there's calls and puts. And what we're basically doing is we're selling put options and call options in rotation. So we go from cash secured puts to covered calls, cash secured puts, covered calls, back and forth, and we're hoping that the strikes will line up and the pricing will line up and that the volatility won't be too great. That is one of the major risks that we're going to talk about in this video, though, specifically with Palantir, because I took this actually at the close of last night. So this snip came from, it was last evening. You can see the price is down 2.24% on the day. Now, if you look at the live price of Palantir, you'll see it's down even more. It's down, to $40.51. And so this option that we sold at $40 per share, in this case, right? So what we actually did is we took 500 shares. That's why there's a quantity of 5. And as I've discussed in my other videos, each options contract is worth 100 shares. And so if you see a quantity of 5 right here, that actually means we're selling 500 shares worth. So we're willing to buy 500 shares at a strike price of $40 per share. So it's the equivalent of 500 shares in terms of our position sizing, right? So to do this trade, we're going to be putting up roughly $20,000. And why is that? Or actually, in this case, it would be exactly $20,000. So if you take the strike price of 40 times 5, that's going to be 20,000, right? So 500 times 40 is going to be 20,000. That's what it comes down to, because we sold 5 contracts times 100 shares per contract multiplied by 40 on the strike price, and we're putting up $20,000 in collateral for this trade. Now, if you look at, like I said, the price from last night at $42.53, the strike price of 40, and then you compare it to the current market price, let's just say before the market closed yesterday, we went ahead and put on this trade, and now this stock is down at $40.51. Well, what's going to happen is this option that we sold, that had a bid of $2.04, and we actually collected over $1,000 for selling these cash secured puts. We collected over $1,000, but what's happening is the option is actually going up in value even more because it's closer to the strike price. Because when we sold this option, right, the price of this stock was at 42. It was above $42. There was over a $2 spread. And keep in mind, this option expires on November 15th. So we are locked into this thing until November 15th, which is basically 1 month away. Today's October 16th. So with that being said, we have roughly 1 month after expiration. And if we take this $42.43 price of Palantir as of the close of yesterday, comparing it to the current market price, you can see that, now it's trading at $40.74. Nonetheless, we're not that far away from our strike of 40, and we still have roughly 1 month out to expiration. So one of the major risks you have to keep in mind with a stock like Palantir is that the volatility is much greater. I've done this against index funds like SPY. I've done this against QQQ. I've done this against individual stocks that have a beta which is lower than the S&P 500. Now, Palantir is going to have a beta that's greater than the S&P 500. That's an important consideration. So if we look at For example, we can actually look at this metric. It should be on FinViz. In fact, Palantir has a beta much greater than the S&P 500. And so what we're looking at here is that anytime you see a beta of more than 1, it'll basically indicate that the stock or whatever instrument you're looking at is going to be more volatile on average than the market, or more volatile than the SPY, more volatile than the overall stock market, right? The index. So in this case, Palantir is much more volatile, 2.72, over 2 times as volatile as the S&P 500, essentially. So that is something to consider here, because even though you're going to be getting more premiums up front with less capital, that is one of the benefits. The drawback is the volatility, as you can already see, is going to be pretty intense. So that's on the put side, right? So we sold 500 shares worth of a cash secured put. We collect over $1,000. We're agreeing to buy 500 shares at a strike price of $40 per share up until November 15th, 2024. We're locked into this trade, right? In the meantime, this option we sold at $2 is now going to be worth $2.50, $3, because the price is closer to that $40, right? So we can actually look at the live pricing as well. In fact, if we go over here to Fidelity, let me go back to trading, and I'll just go ahead and try to place like a mock trade on Fidelity and see if we can make this happen. So we're going to go to options trading and kind of just look at this and see where we're at in terms of the actual options pricing based upon theoretically the cash secured put we sold yesterday versus what the pricing is right now. So if we look at options, right, we type in, once this loads here, we will go ahead and load my Roth IRA account since I'm approved on options trading there, and we will go ahead and try to place a pretend trade for this. And let's go ahead and put in PLTR, and we will go ahead and hit sell to open, put option, and we will do a limit price, or I'm sorry, the strike price actually. We will choose the expiration and all the strike price November 15th. We're going to look at that same option at the $40 strike and see where it's trading at. So as I kind of expected, right? So now we're trading at $2.49, which means if you sold it, or if you waited to sell, instead of selling it yesterday, you waited to sell until right now on that 500 shares, right? You're still agreeing to buy at $40 a share, but now you're collecting over $1,200 just due to the fact that that option is worth more because it has a higher chance of being in the money. So now it's trading above 41, right? So the price is constantly fluctuating. There's a lot of volatility, but that option price is going up as it gets closer to the strike price. And that's what you can expect, especially being 1 month after expiration. Now switching it over to the call side. That's the next thing I wanted to talk about. So that was the put side. Now we're going to be going over to the call side here. So we're agreeing to sell our shares at an agreed upon strike price. We're going to assume in this case we already own the 500 shares, and now Palantir's kind of bounced back. But nonetheless, as we sold this covered call at a strike price of 45, agreeing to sell our 500 shares at a strike price of $45, we have the bid at 229, which means based upon these 5 contracts, we're going to collect $1,141 after commissions. And this is also expiring on November 15th. So just for the sake of simplicity, I'm switching between the calls and puts based upon the same price as of yesterday, right after the close. Now, if we look at this trade so far, this is actually working out in our favor, right? Because if we look at a $45 strike, at least for right now, it's actually worth less, right? So technically we could buy back the option, close out our trade, and pocket the difference in this case. So 1141 less the 866 would be our profit in that case, which would be a few $100s, right? So we could do it that way, just close out the trade and lock in the profits. Or you could just wait until expiration and just keep the $1,000 and do nothing, wait for it to expire, because that $1,000 is still going to be yours no matter what. You sold these 5 call options at a strike price of 45. You're agreeing to sell your 500 shares at a strike price of 45 up until November 15th. You're keeping this $1,141 no matter what. But if you were to close out your trade in this case, you could technically do that, and you would actually be in the green, because you would simply subtract after commissions, right? 1141.75 minus 866.75 is what you would buy it back for. And of course, that's also assuming you haven't withdrawn the cash that you got from selling the covered calls in the first place. But that's one way you could do it, right? Is just use the cash you received from selling the covered call to buy back the option, since the option is now cheaper. I mean, you can see the bid is 174. The bid right here when we sold the covered calls was 229, right? So Now, when it comes to Palantir and more volatile type stocks, a lot of people will say, well, it's better to do on a weekly basis than a monthly basis just due to the volatility. And also you have time decay working in your favor. So this idea of time decay is when the option gets very close to expiration. Like if you're looking right here at October 18th, October 25th, that option is going to basically deteriorate in value due to the fact that it's so close to expiration, and so it has a much less chance of actually going in the money. If we look at a call option, for example, that's only 2 days out to expiration, we're practically going to get nothing for it. Why? Because that time decay has already eroded pretty much all the value of the option. So in this case, we're going to get less than $10 after commissions. If we look at a closer dated option, though, it's trading currently at 41. If we looked at like a $42 option, now we're actually talking at least something decent. Within 2 days, we can make over $100, right? But the idea, or hopefully, is that if the price of Palantir does not move back up to 42, this option will pretty much deteriorate to nothing. At that point, we could either buy it back or just wait for it to expire worthless and then collect the 126. So I mentioned the volatility as being a major consideration with this stock. The big problem, like I said, is that when you're doing the wheel strategy, ideally you want to have less volatile securities. You want to have ideally a beta of less than 1. When we're looking at a beta of 2.72, that means this is going to be much more volatile than the average S&P 500 index fund, right? Or the index itself. So with that being said, you have to keep an eye on that. When you're selling these options, one thing to keep in mind, delta. So just type in delta. I would recommend everybody who is trying to research this in terms of the wheel strategy, I would type in like delta option is the wheel strategy, and I can leave a link in the description for you guys as well. But this is going to be very important because when you're looking at like what type of delta to choose, you have to look at certain deltas. So, you'll have Reddit people saying like 0.3 is the best delta. I actually prefer a delta of 0.2. That's kind of what I'm searching for. But I encourage you to research this. Type in options, wheel strategy, delta. What does it mean? It can get a little bit complex, and so I encourage you to research it and do some deep diving yourself. And I can maybe make a separate video specifically on delta and how this works. But basically, I for example, will choose a delta of 0.2. Hopefully, what that means is the option will have an 80% chance of expiring worthless and a 20% chance of going in the money. So ideally, I will have an 80% chance of winning and a 20% chance of losing is the idea. Because remember, the buyer of the option is hoping I lose and vice versa. It's kind of a zero-sum game. I'm the seller of the option, whether I'm selling a call option or a put option, doing the wheel strategy. And so the lower my delta, right, the lower the chance that it's going to go in the money. So if I have a delta of 0.1, the idea is 10% chance of it going in the money, 90% chance of it expiring worthless. And so I think this is a pretty good article, I think. I'll probably leave this one or another one in the description for you to check out on delta and your risk associated with a specific option going in the money, because that's going to be very important, especially when we're dealing with a volatile security like Palantir. And remember, guys, this is not going to be for everybody, okay? And I definitely recommend you diversify, especially if you're doing this against more volatile securities. So although the capital requirements are lower, right, we're putting up roughly 20,000 versus in some videos I've mentioned putting up 50 or 60,000 for the same type of wheel strategy, depending on the ETF and how expensive it is, etc. You're putting up roughly 20,000. Your implied volatility is higher. You're going to be raking in those premiums, but at the risk of the options going in the money, right? So you have to look at that delta. You have to look at your risk overall in terms of how fast can the stock move. As you can see, the stock's already down 3% today, and the day's not even halfway over. It's only 9:41 Central Time, so the market still has several more hours. And so this is just an idea of what you can expect when you're doing this. That being said, there are two ways, like I said, to make money in the market. Okay, so you can make money on the upside via share price appreciation or through cash flow. Personally, I am a fan of the cash flow idea. I like the idea of earning regular income, using options trading for that, also using dividend stocks, real estate investment trust, etc. So if you guys like those topics, consider hitting that subscribe button. Check out Daily Investment Advice. I have a lot of free resources, especially if you're new to the markets and you want to get even just some beginner education. Check out investing fundamentals. Check out options trading. Check out the wheel strategy. Check out retirement strategies and cash flow, how to earn income, all kinds of stuff, personal finance. We have a lot of education, especially if you're new to the markets. So check out dailyinvestmentadvice.com. Also check out our sponsor, Seeking Alpha. They have a great network, basically, of there's thousands of different securities they discuss on their website, and they have a lot of people posting, professional people who know the markets very well, a lot better than I do, posting on Seeking Alpha, talking about different securities and doing in-depth analysis on ETFs, mutual funds, individual stocks, etc. So check out our sponsor in the description. With that being said, guys, thank you so much for tuning in. Hope you enjoyed this video. God bless, and we will see you in the next one. Take care.